Good afternoon, everyone. Nice to see you again. You guys lasted for 2 days. God bless you. Very good. The panel that we are about to moderate today, as you see from the title, it is delegate-sourced quick questions. So it is attendees, charter attendees, members, family offices that have been attending the Family Office Club events for years. They wanted to make a contribution to the event, and based on their communication with Richard and his team, they kind of formed this scheme that we're going to see today. This is very interesting because it's coming from you. It's not always Kamil who's the one who is tailoring and curating the questions. It is you who are doing that. So I'd like to start by asking my esteemed panelists to introduce themselves. Just take, please, a short 1-minute introduction, your name, the name of your firm, your sweet spot, what keep you up at night. In maybe 1 minute, tell us while you are here so these beautiful people can engage with you and direct their questions to you. And then we're going to open the floor for their questions, which we have already, I think, 15 or 20 of them. Thank you. Welcome. We can start from there if possible.
Yeah. Good afternoon. My name is Simon Littlewood. I represent the Lee Family Office, which is an Asian-based family office that invests worldwide. The focus of the family office is on what we call quality of life-related investing. So it's everything related to improving quality of life, so education, healthcare, sustainability, and food. Before I did the family office, I used to run institutional funds. And then prior to that, I was working in investment banking and structured products.
Thank you, Paul.
Hi, Paul Kang. Our family is also from Asia. We got started out in consumer products and hotels and retail, some real estate, and I do the passive investing here in the U.S., so mostly into a range of funds as well as certain direct investments.
Good afternoon. My name is Renov. I'm a partner with Beechwood Ventures. We're a New York-based single-family office. We've been on Wall Street since the early 60s. We owned and operated an investment bank for many years, and raised over $3 billion for over 400 companies, and we've operated as a family office for the past 20 or so years. Our general focus is on early-stage high-tech, clinical-stage biotech, sector agnostic, usually doing seed or A rounds. We generally try to create platforms, so we have several accelerators. We run boot camps throughout the year. We've launched travel tech boot camps, sports tech boot camps, marine biology accelerators, general accelerators, homeland security accelerators. That's pretty much so. What keeps us up at night? We're generally always looking for new investments, new things to add to our platforms, new co-investors, new platforms to invest in. That keeps us pretty busy.
Great, Evan. Thank you. Go ahead, sir.
Hi, good afternoon. My name is Benjamin Marks. I'm the founder and founding principal of my family office, Leveraged Equity Holdings Group. We're based here in South Florida in Fort Lauderdale. We're a primarily commercial real estate investment and development outfit, operate in 7 states, mostly in the Northeast, from New York all the way down to South Florida. We primarily specialize in multifamily. About 70% of our portfolio that we own and operate as principals is in that asset class, and about 30% in retail. My background is as an economist and in capital markets, both on Wall Street as well as in the D.C. area, where I did consulting for CBRE, M&M, and kind of parlayed some of that inside information during the market tumult the last 10 years into our own family office.
Great. Thank you very much. What we're going to do, those 15 or 20 questions, like I said, we have them all prepared, and I'm going to start with the first question, and then anyone of the panelists that wish to address the question, or if you wish to have a follow-up to it, just let me know, and this is how we're going to do that, and hopefully we'll be able to manage the time. And I want the audience to be prepared toward the end. After we finish our questions, we're going to maybe any one of you who want to ask a question, we might bring you to stage to also do the same thing. So get ready. The first question is, as you see posted on the big screens on both sides, it says, for the family offices that leverage their real estate purchases and acquisitions, how do you go about finding a lender?
I'll go first.
No, I'm going to give you a freedom of choice. Just give me a signal that I like to address that question, and that'll be great. Go ahead, sir.
Well, in multifamily, I think it's a lot easier because you have the GSEs, so Fannie, Freddie, FHA, which are subsidized by us as taxpayers. So that tends to usually be competitive for assets that can support them. And quite frankly, our position on multifamily has been if it doesn't fit into a GSE debt financing structure, we typically don't do it. Retail is a little bit more interesting. I think that's one sector where the baby may have been thrown out in the bathwater, and the variation in debt markets for retail assets, particularly credit tenants, is really interesting and dynamic and competitive. CMBS, which we had used in the past, was very unstable and unpredictable. Uncertainty of execution was an issue. So I guess the short answer is it depends what asset class you're in. For multifamily, it's a lot simpler. Retail is much more dynamic and competitive.
So do I understand that based on the size and the dynamics of the deal, you would create a short list of capital sources, and you will just send notes to all of them and asking them to if they have any letters of intent?
Exactly. I mean, my background's in capital markets, so I've kind of seen the hot dogs being made, while I think most other folks are just busy eating them. So we know what things should price at, and actually our acquisition strategy works backwards off of what we can get in terms of debt.
Anyone of our panelists like to follow up on this?
For larger transactions, we actually recommend trying to get some leverage from Asia. It's probably cheaper and friendlier. We actually do some unitranche kinds of investments where we provide not only the equity but the mezzanine and the debt as well. But certainly we have a lot of lending relationships, and to the extent that that can be helpful, for larger transactions, the Asian capital sources can be very economical.
Evan, you have any thoughts on the matter? You are the Wall Street.
We don't, right? Yeah, but we don't really do real estate.
All right. So we jump to the next question. The next question is a bit longer. It says, half of our clients of families, beneficiaries, wealth is lost in the market downturn. What do you and how do you handle it? How do you communicate it? We work with families who cannot afford to lose half of what they have. That mindset is part of every investment decision we make, from portfolio construction to picking an individual stock. It is a very different way of seeing things than thinking in terms of how can I make more, but that's the mindset that helped us and our clients weather many storms over the last 50 years. I know the question is long. There is a section of it that really summarized the entire question that says, half of our clients' families, beneficiaries, lose their wealth in the market downturn. How do you handle it, and how do you communicate it?
So I'll jump in and I'll say we're certainly in a very high-risk, high-reward area when it comes to early-stage venture. We have 100 and 500x returns in our portfolio, but with that, what comes with that, obviously, is a lot of risk. So I think when, we're always trying to expose other family offices to investing in the high-tech space as well. And the trick is always to de-risk it. How do you do that? You do that with a portfolio approach. It's the only way, to be investing in early-stage venture. And, when families come to us and say, hey, we heard you have a great company, and it may be we're investing usually, at valuations that are sub 10 million, usually 5 to 7 pre-money. So we're talking about pretty early stage. We're talking about a long cycle. Generally, on average, it takes probably 7-8 years for an early stage venture company to, if it's going to do a sale or an acquisition. So, we certainly would always encourage, taking that portfolio approach if you want to come into venture, and that's how we do everything.
Great, Evan. Thank you. Simon, you have any thoughts on downturn?
Yeah, I think the key is not to lose the money in the first place. So I think if you know...
Very genuine idea. We never heard before.
Well, I think if you know that the families that you're representing can't afford to lose the money, then from day one you design the portfolio so it's lower risk. There's no point going into the startup space or the high tech. You want to be looking at assets that are much lower risk.
So do I understand that your thought process starts with the risk tolerance that the family has?
Yeah, it's no different from any client. You sit down with them and say, what's your objectives? And if they say the objective is to preserve capital rather than make a tenfold return, you don't put them into Bitcoins. So it's really knowing your client and designing the portfolio, which is the job of family office managers.
Beautiful. We're going to move to the third question that goes, after a family office decides that they want to get more information on multifamily property, what are 3 things they want to know first?
I think we're back to you.
Yeah, it's funny. I started investing in multifamily about 15 years ago and been through a couple cycles. I don't think I've ever seen that asset class become so popular for so long. I think part of the reason is in a whole other discussion, but I think I'd be very careful. I think it's really a bifurcated market, like a lot of commercial real estate is, in our opinion now, meaning that there's sort of A and B class properties, which there's a lot of supply chasing relatively small and falling demand, and then there's sort of class C and below, which is affordable housing, of which there is no supply. There's no new supply that's being built in this country, and because of things like the amenization or mechanization and the Amazon effect, I should say, you're seeing that demand group actually increasing, and no one's building C-class affordable housing because it's not economic to do so. So to properly answer the multifamily question, it depends on what asset, where you are within the space.
Paul, you have any follow-up to that?
So our experience in multifamily is that for the long term, we like the newer, probably the more premium properties in any market. And so we like value added, but we like value added where you get that property up to, being one of the best properties in the market. And so whether it's student housing or multifamilies, we have tended to pay up a bit for the better properties, and we think that that's better for the long term.
Great. The next question is, in the multifamily field, again, cap rates have become very depressed sometimes in the 4.5% to 5.5%. I have seen them much lower in London and in New York. And even as interest rates have begun climbing, cap rates have not risen accordingly, but continue to decline. What advice do you give to apartment owners and investors today, especially when one views the possible pending inverse T-bill yield question, hang or sell everything? So what advice would you give to the multifamily and maybe in real estate in general, due to what we see of the continuing depressed cap rate while the interest rate is climbing? In my experience of quite a few decades, I haven't seen them working parallel. They were always in inverse. So you like to take that one, because Evan is giving a green light to you on this one.
I think the real question is what's going to happen with interest rates. If you're buying stuff where the spread above cost of capital is less than 100 basis points, you're basically only going to make money if interest rates go down. And I actually happen to be of the opinion that we have an inverted yield curve, not because we may have a recession, but because we actually have deflation in this country. And I think when you look at cap rates of low-risk investments, you look at treasury bonds, the reason they're inverting is because there's really no inflation, even when 96, 97% of the country is employed. So I think the real answer to whether you invest in that kind of cap rate market is really driven by your interest rate expectations.
Simon, any thoughts on the matter?
Personally, I'm selling. So who else do you sell or do you stay in? We've been investing in U.S. real estate since the downturn. We've had a great ride in the last 8-10 years. But what we've seen in the last 6 months is it's getting increasingly hard to sell the portfolio. And I just got an email saying we had a sale fall through. So it's definitely a lot harder to dispose of assets now than it was earlier this year, and I think that'll get worse next year. So I would sell. Put the money in the bank and wait for better pricing.
There is a common theme in the family office space that families like to invest together. Do I fully agree with this? I personally do not agree with this. Is it a common theme? Yes, I have seen deals where, I partnered with family office, but I don't want anyone to misunderstand that families only like to invest together. That would be very incorrect. There is a preference. It's because they feel more comfortable. They align their interests together, but that is not an absolute at all. Just an idea to share with everyone. Our next question is, what is the biggest determining factor for you and your family office to become a partner in another real estate syndication? You want me to answer that?
Can I make a comment on the last one, though? Is that we have the same experience that it's not so easy these days to sell down some of your multifamilies, especially in gateway cities. And so one of the things that we have done is to make sure that our financing is the kind of financing that we want. And so we are extending maturities and other things to protect ourselves if one of the markets or the interest rate market goes against us. And so if you can't sell your property, I think you should be refinancing.
Ladies and gentlemen, do you agree with me that our panel preferred difficult questions? Because the simple one they didn't want to look at. So let's have a difficult question for them. What is the thought of panel on investments in the area of precision medicine, longevity solutions, and next generation diagnostics tools to replace echocardiogram or like tools in the hospitals of cardio-oncology patients?
So I can certainly take it. We definitely invest in biotech. We invest in medical devices. Obviously, in an aging population, we're always continuing to look for new innovative ways to help. We look at a lot of devices in the EKG space that will revolutionize them. So I definitely believe that it is something that people should be looking at. Healthcare in general, biotech in general, especially, like we said, we look at a lot of on both ends. When it comes to NICU and neonatal, and in the aging population, I think that we're seeing a lot of innovation in those spaces.
Thank you, Evan. Go ahead, Sam.
Yeah, that's one of the main sectors we invest in. So I'm happy to answer that one. We focus on the emerging markets, particularly in Asia. And the reality in Asia is that they do not have the hospitals and the doctors and the nurses. And they're not going to go and buy all the drugs from Europe and the US. So they're looking at the alternative ways of keeping people healthy and solving the health problems when they have them. So that is the personalized medicine, it's the preventative medicine, it's many of the new technologies that are being developed. And it fits very nicely with some of the large Asian companies, the Ali Health, the health division of Alibaba, where they're very much focused on data analysis. And a lot of the medicines that are being developed now, the technologies are coming out of big data.
Yeah, I'd like to, we also do a lot in this area. Precision medicine is really kind of a buzzword that's really the basis for all of the therapies. But what we do find is that it's become a way for a lot of companies to justify research when it can be a little duplicative in terms of what the results are. So, last week I was talking to the Mayo Clinic because they are testing one of the therapies that we're thinking about investing in. And I find out that the Mayo is testing 15 different products. They're all slightly different ways to approach a particular indication. And so it's gotten to a point where you've got to look very carefully as to what you're investing in, because you may have 10, 20, 50 different solutions to the same problem. So I think it's an area that we're starting to get to a point where we've overinvested in some of the popular areas.
I think just on that point, we had a similar experience with something we looked at a few weeks ago. It looked to us like a very interesting solution. And we went back to some of the people we know here in the US, and there were 5 similar companies in the US. But the interesting thing for us is that none of those companies are addressing the emerging markets. So the only company in the field addressing the emerging market was the one that we saw. We asked those 5 companies if they're interested in looking outside the US, and they aren't. So the reality was for us there was no competition, even though there are other competitors in the field.
You know, I'm going to ask you a question that is not pre-scripted. Coming from yourself, from a mature market, in a few words, what attracts you to the emerging market in this state of the economy?
I've spoken to a few people here, and they've asked me, they've said they're doing 10, 15% returns.
I see.
And I've said, I'm not interested because our minimum return on our investment is 10 times our money per year. So that's why I'm interested in emerging markets.
I see. Great. Now it seems like we're going back to an easy one. What is the best way to have you respond to an email? When you are interested but tentative, without pushing you away. Should I call you?
That's a good question.
I really like to have everyone's answer on this one. Go ahead, make it.
I don't want to pass the buck. I really think it depends on the context. And, you know, we're real estate investors, so, you know, we operate in a very small box. We're not nearly smart enough to look at emerging technologies and AI, I think, like some of these other gentlemen. So we know our world pretty well. It really depends on the source and kind of the background that we do.
Do I understand that you like to read a hook, what we call in the grammar, a hook into the message that we send you initially to find out that it fits into your perspective or into your niche in the industry?
Yeah, I think that's fair to say.
Evan, any thoughts?
So generally, you know, if I get an email about a company, if I'm looking at something, I think a no is just as good as, I try not to leave it open-ended. You know, we can tell very quickly if it's something that we actually want to pursue or want to do more due diligence on, or we're just saying, okay, this is a pass. So we try to be good about getting back to people and saying, you know, the answer is no, or we think this may be good for someone else. You know, being in a space where we operate between a lot of family offices and a lot of venture, so you know, we have weekly calls with, you know, early stage venture companies, you know, growth stage venture, you know, VCs. So if it doesn't fit for us, we try to say, okay, we'll look and see how we can help you. But you know, I always welcome a call, and I think that if it's not for us, we're going to just tell you straightforward, so you can move to the next person.
Beautiful. Paul, you like after you receive a pitch that after you review it that a phone call will follow, or you normally respond to encourage that phone call?
Yeah, so we don't really take a lot of cold calls, but certainly if there's a reason for scheduling a call, we can certainly do that.
So you would write back the issuer to encourage them to call you and to schedule a call? Or to
Sure, if
schedule a
we're
meeting?
interested in talking, we would schedule a call. Yep. And obviously these conferences are a much easier way sometimes to get a hold of them.
Simon, how do you do it in your world?
I get about 10,000 emails a month.
That's all you do?
Yeah.
Okay.
Email's not a good way to contact me. The best way is through personal introduction. It's through a shared contact. We don't tend to look at third-party deals because we just don't have the capacity. So if we get somebody phoning up because they know, or a recommendation from a friend, that'll get us to actually dig out the email.
That has been in the last couple of days, or yesterday and today, the theme that was most accepted by most of the sponsors or investors.
Well, I was sitting with one of the families in Hong Kong having dinner, and we had a European guy with us, and he looked at my inbox and saw I'd got 13,000 emails that day. And he said, that's a lot. And then this other woman from the family office in Hong Kong showed her phone. She'd had 158,000 that day. So the chances of us actually reading emails is very small.
You know, the inundation of email, I find it sometimes to be the fault of us on this side and the issuers on the other side. we need to be more specific on our websites and on our presentations and our flyers, as to what we subscribe to and what is our niche and what is our focus, and for the issuers to really do their research, their due diligence before they contact us, for their email to be read and to be considered. It seems like it worked both ways. It's not always, Evan. It seems like I don't mind to stop.
You hit on a very good point, because a lot of times people will get calls from companies or emails from companies, and I can tell that you haven't taken 2 minutes to actually understand what we're looking at. So I think that is a very important point when it comes to the companies in this room, to really try to understand, who the investor is and what they're looking at, so you're not wasting your time and you're not wasting, the investor's time.
My next question is going to be, how do family offices evaluate and manage the security risks their principals face, and how can firms that help mitigate those risks be more present and helpful to those offices, knowing that family offices always have advisors, third parties, in-house or third party? So how do you see from your experience that those advisors help mitigate those risks, if they are not only security for their own being, but also security for their data, for their staff, and for their bookkeeping and private information? Who would you like to start?
I think for us, risk management is a really key issue, and it starts with really us as principals understanding what we're investing in. And as I said before, we're commercial real estate owners and operators. So everything we invest in has that kind of component to it. And sometimes, even when it's not a property deal per se, it may be a technology that's being rolled out in our space that we either use and understand. And advisors are great, but there's nothing like actually eating your own cooking. And that's sort of how we mitigate risk in our family office.
So we're actually pretty conscious of all of the privacy issues. We actually decentralize all of our information, so you could not go online and kind of centrally figure out, let's say, what all of our holdings might be. We still have some things in physical file cabinets that are, quote, offline. We've had to do some things where, I've had people just kind of drop by the office when they knew where my office was, and so my business card actually doesn't have my real physical office. And so those are some things that we have had to do.
Great. The next question is back to the category of the difficult ones. If an investment manager has the same investment strategy, in this case, a U.S. value large and mid-cap equity strategy, inside of a separately managed account structure as well as a hedge fund structure. So you have a managed account structure and a hedge fund structure. Which structure would be preferable and why? For this question, assume the fee structures are identical. Go ahead.
For us, I think it's simple. We don't really are concerned that much with structure. We're looking at after-tax returns after all fees. And really, we run that through a filter of, based on how much time and oversight we'd have to put into that investment, is it going to under or outperform, a diversified basket of, dynamic index funds? So it's really very quantitative.
Evan, any preference?
So I guess I'll relate it to, the way I'll relate it to more when it comes to structure is what we see, in the VC space, where we're either thinking, a lot of times when someone is coming to us with a deal or we're looking at it, it's how are we actually coming into this company? So a lot of times people are pitching either directs or SPVs or through a fund. So I do think that you have to be very conscious of what you're investing in. We like to do a lot of direct deals, but a lot of families, in order to get exposure to a deal, will go into an SPV and will just have to understand what type of fee structure or management fee that they're taking on it.
Great. Paul, my next question is, how important is social, environmental impact in your investment decision-making process?
So I just want to follow up on the last question. If you're doing a fixed income portfolio, we definitely assume that you want to do a managed account, because a lot of times we've been in situations where the only way to really get your money back is to hold to maturity, and funds will be forced to sell because of redemptions, and it's just not a good way to do it. In terms of environmental and other things, We have continued to wrestle with the whole impact investing arena, and we still are not satisfied that that's necessarily the best way for us to go. We certainly are contributors to nonprofits and other things, but we're not quite sure that the best way to achieve those kinds of things is to make impact investing. So we don't consider that as directly as some others do.
Sustainability is one of our core investment themes. I've been in the sustainable space since the 1980s, so for us it's slightly different because we've been in the industry for a long time. We can spot the good and the bad deals. Generally speaking, obviously the sector has underperformed many other technology sectors, so you have to be extremely careful the investments you pick in the sustainability space.
Beautiful. After we touch on impact investing, the next question is about ESG, about environmental, social responsibility, and governance. It seems that ESG has become a big topic in articles on investing, but family offices seem to be slow to adapt to embracing this style of investing. How important is it to your family, and is it likely to become more important over the next 12 months? ESG.
I was speaking at an ESG conference a couple of weeks ago, and everybody was talking about how important ESG was. So I stood there and said, I don't understand what ESG is. Can anybody tell me what it is? And there was silence because nobody really knew what it was. So it's a buzzword. There's more and more compliance required for listed companies and funds, so I think it will become more important. But for those that are not forced to adopt it, unless they specifically want to do it for the sake of the family members, then I don't see why they would want to put themselves under those constraints.
Anyone else like to follow up on ESG?
Yeah, I agree. I wasn't really clear on what it was either, and I've yet to have anyone succinctly explain to me what it is or how it increases returns. It's nice and all. We tend to be of the opinion that technological advancement and things like electrification and solar will actually win out for economic reasons, not necessarily for environmental, although they are environmentally beneficial. So that's just not a space that we operate into as for-profit investors.
We all realize that in the last few years, family offices chose to build their own team, an in-house team to do all the investments and to have their services provided to them by their own internal team. So this question is, just to share it with the audience, what staff and other resource costs have you taken on to make direct investments? Have these costs been justified by avoided management fees and better net returns?
Yeah, so like I said, we generally try to do directs, and everything we do is internal. If we ever need outside consultants when it comes to due diligencing, any specific space or sector, we'll always go outside. But everything we've done is through our own internal teams in order to, and we think that ultimately, I guess that gives us better returns because we're actually managing everything. We understand everything. We see everything from the first time we get a pitch to the actual investment.
This is a side question. Do you think the shrinkage of hedge funds in the last few years has been one of the reasons? This has been one of the reasons that mostly family offices have been building their own internals?
I do, and I think that as hedge funds continue to lack their competitors in all various forms, including indexing, I think that's why a lot of family offices chose to self-manage. And to answer your previous question, which I want to tie into, part of why we operate in the spaces that we do is that we feel our team already has a competitive advantage. So if we have to start going out and hiring lots of consultants, again, within the real estate sphere, we're probably too far ahead of our skis. And that's kind of...
I'd like to ask the audience if they have any question for our experts. You have decades of experience here on the stage, and I would encourage you to take advantage of this. Any questions? Go ahead, sir. You need a microphone?
I'll go for. I mean, within real estate, I think there's a lot of energy efficiencies that actually work. In my humble experience, most of them do not, at least not consistently and as advertised. So, one of the few positions we've taken outside of real estate investment holdings is actually a firm in that space, where we can actually test and have complete transparency, and we direct as principals in those cases. As for the rest of the question, I think it's very difficult. Unless it augments returns, I don't really think it should make a difference from a private investor's point of view.
At this point, I want to thank everyone for their attendance, and please join me in thanking this great panel for their contribution. Thank you. Thanks.